Hello, and welcome to this session. In this session, we're going to pick up our discussion of Chapter 20, Inventory Management, Just-in-Time, and Simplified Costing Methods. Now, in the previous session, we talked about the economic ordering quantity inventory management from a retailer's perspective or from a merchandising perspective. Now we're going to focus more on a manufacturing setting. However, a lot of principles and the thoughts behind them can be used in the merchandising sector as well. It's not just limited to manufacturing. So we're going to continue our discussion now and focus on just-in-time, and then the simplified costing methods such as backflush costing and lean accounting. With those two, we're just going to touch on some discussions on those. We're not actually going to do any journal entries or anything, but I do think that it's important to discuss those and some pros and cons along with that, as well as enterprise resource planning systems or ERPs, so that we can gain as much information as possible, and that ERP system can make a just-in-time system possible throughout the whole company and each part of the value chain. So in the just-in-time system, we're going to look at just-in-time purchasing. Now, just-in-time purchasing is where we purchase materials or goods so that they are delivered just as we need them for production or sales. We don't necessarily want them. Now, there may be times where we need to have a small amount of materials or goods on hand for safety stock reasons. But the overall concept of just-in-time purchasing is where we purchase materials or goods so that they're delivered just as we need it for production or sales. Now, just-in-time purchasing is not guided solely by the EOQ model we discussed in the last session, because that model only emphasizes a trade-off between relevant carrying costs and order costs when we're ordering at the EOQ model level. And our last session, we talked about the basic EOQ assumptions. There are more complicated and more complex EOQ systems out there that can take into account quality costs, stockout costs, and so forth. So when we talked about the EOQ model last time, there are more complex models out there that will help give us a little more insight and take a lot more a number of other factors into consideration. But the just-in-time purchasing is not guided solely by the EOQ model that we discussed, because that model really only emphasizes the trade-off between relevant carrying costs and ordering costs and not other aspects of the business. So just-in-time purchasing reduces the cost of placing a purchase order. Why? Because one, we're going to have long-term purchasing agreements with our suppliers, and they're going to define price and they're going to define the quality terms. And that's going to be the contract we have with our suppliers. So any individual purchase orders covered by those agreements, we're not going to have to do any additional negotiation regarding price or quality, because we got our agreement set regarding both of those. Just-in-time purchasing can reduce the cost of placing a purchase order. Why? Because now companies are using more electronic links to place purchase orders, and a small fraction of traditional methods by phone or mail. And then finally, companies are using purchase order cards, and these are similar to consumer credit cards. And what a purchase order cards is that when purchasing personnel stay within preset total and individual transaction dollar limits, then the approval procedures or the procurement of the approvals are not required. So as long as you have a spending limit of $500 and you spend less than $500 and at approved suppliers only, then those orders are going to automatically go through. No additional approvals are required. Where approvals are required is when a purchase it needs to be made either at a higher dollar amount than the pre-approved amount already, or to a supplier that's not already pre-approved and not already vetted. Now, relevant costs to the ELQ model are the carrying costs and ordering costs, and we talked about that. Inventory management includes all the costs: purchasing costs, stockout costs, cost of quality, shrinkage costs, in addition to the carrying and ordering costs. So for just-in-time, relevant costs are going to include the purchasing costs, ordering costs, opportunity costs, carrying costs, stockout costs, and quality costs. All those costs we dealt with in the first session, and we talked about those. And again, especially with the quality costs, we referred to the previous chapter, chapter 19. So if you want to, you may need to review those and review all 6 of these costs actually in this chapter to make sure that you're familiar with what each one encompasses. Now, in the supply chain analysis, let's redefine supply chain, or not redefine, let's review the definition of supply chain. It's the flow of goods and services and information from the initial sources of material and services. So wherever those sources of material, services occur, from their very initial sources all the way to the delivery of products to consumers. And this can be regardless of whether those activities occur in our company, the same company, or if those activities occur in other companies. Now, supply chain members are going to share information and plan coordinated activities. We want to be very in tune with our supply chain. We want to make sure that all parts are working smoothly, in order. Why? Why do we want to share sales information? Well, we want to supply sales information to our supply chain so that we have fewer stockouts at the retail level, reduce manufacturing a product not immediately needed by retailers. And with the stockouts, we have fewer manufacturing orders that have to be rushed or expedited. And that also allows each company in the supply chain to have lower levels of inventory. For example, if I make toilet paper, I've got to have some type of paper. Unless I produce that paper from wood pulp all the way down to and everything else in-house, I'm going to have to rely on outside companies for at least some materials. Lower levels of inventory can be held by each company in the supply chain, thus reducing overall inventory that's not necessary. Now, let's compare inventory management from a MRP system and a just-in-time production system. A materials requirement planning, or MRP, is a push-through system. We see our demand forecast and we push inventory through to build up inventory to meet the anticipated demand. So we manufacture finished goods for inventory on the basis of demand forecast. We push through inventory to be sitting in our warehouse so that when the customers call and place an order with us, we can ship that out immediately. Just-in-time production is the demand pull system approach. So it's the opposite approach, and it's called lean production. We only produce product when it's needed in the next step in the production line. So we only produce product when we have an order. We're not going to build up our inventory levels like we would under an MRP system. We keep our materials at very low levels. We keep our work in process at very low levels. We keep our finished goods at very low levels. And we only produce when there's an order or when there's a demand for the product. Under an MRP system, we make product forecasting demand. Just-in-time production makes products when there's demand. So we're anticipating demand in MRP systems, and so we're producing for inventory. Whereas under a JIT system, just-in-time system, we only make items when there's a demand for it, when there's an order placed. Now, when we talk about MRP systems, we have to look at the inputs. We have to look at the demand forecast for final products. We have to look at all the materials, detailing, bill of materials, detailing the materials, components, and sub-assemblies for each final product. So, and then we have to determine company's inventory of materials, components, products. We not only need to have demand, we need to forecast demand. We have to know all the materials and the components and sub-assemblies for each product, and then have information about the inventory levels that we have for each one of the materials, subcomponents, and finished good products as well. So we have to know what our demand is, what constitutes materials and the various components of our product, and then the inventory levels associated with those components. So taking into account the lead time required to purchase materials and to manufacture components and finished products, what's going to happen is a master production schedule specifies the quantity and timing of each item to be produced. So what we'll do in an MRP process system is we'll take into account all the things, the components, the lead time to get materials into our production floor. We're going to create a production system or a production schedule that allows us to make X amount of each and every product, and then how long we're going to spend doing it. And we're going to actually time, let's say, for the next 2 days, I'm going to be producing widget X. The next 3 days, I'm going to be producing widget Y. The next 7 days, I'm going to be producing widget C. So we have these different widgets here. And these different items, we're going to schedule manufacturing production on each individual item. Once production starts to schedule, the output of each department is pushed through the production line. So once I manufacture these outputs of each department, it's going to be pushed to the next department, the next process in the production process, in the production line. So with that, since we're going to have a buildup of inventory, maintaining accurate inventory records and costs is going to be critical in an MRP system. Why? Because we're going to have a lot more inventory to account for. So we need to make sure our inventory records are accurate and controlling our costs and having an accurate level of costs as well. Now, comparing that to just-in-time production, remember we talked about it as a demand pull. We only produce something when it's ordered. We only produce, each component in the production line is only produced as soon as and only when needed by the next step in the production line. So when someone out further down the line needs something, then we make something to satisfy that production process down the production line. Demand, actual demand, not forecasted demand, but actual demand is going to trigger each step of the production process. Starting with customer demand for finished goods, and then it's going to push a demand or it's going to pull demand from work in process and then pull demand from material. So we're actually working with, once the customer places an order for a finished product, then we have to go backwards in time backwards in the production process to pull the materials, to pull the labor needed to make those finished goods. Now, as customer information systems get increasingly sophisticated, computing power allows companies and processes to analyze large quantities of data. Companies are able to develop deep insights into the need of customers. So what you're seeing is you have very little purely just-in-time systems. You have very little, you had more of it, you've seen it shrink now, of MRP systems. And what you're seeing is combining the best features of MRP and JIT systems, anticipating demand changes to some extent, but continuing to operate flexible production systems to quickly respond to fluctuations in demand. So if we see and we expect some changes in demand, whether actual or forecasted, we can quickly respond to those fluctuations in a lot more timely manner, a lot more nimble manner. So we're combining the best of both systems. And this was what an ERP system will allow us to do. Now, when we talk about features of a just-in-time production system, let's talk about what are some things that are unique to just-in-time production systems. Well, the first feature that's unique is manufacturing cells, or the concept of manufacturing cells. And that's where production is organized in small, tight-knit areas where different types of equipment are grouped together to make related products. What is the purpose of that? Well, the purpose of that is to minimize the transfer of goods from one production system or one machine to the next machine that's needed in the production process. We want to minimize the transfer time and be able to send that directly over there, minimize the time that the materials are being transferred or they're being handled. So we want to group those different equipments together to make the related products. This allows us then to have the next feature where workers are hired and trained to be multi-skilled or cross-trained. Because now workers are going to be important to be cross-trained in different areas. And why is that? So that we can all detect quality issues based on our experiences working in working on different equipments. If we're producing something and then we're assembling something and then we're packaging something, well, everybody in the process should be able to identify defects, identify issues with machines. Maybe we're not being maybe the products are not defective, but maybe there are some issues with the machine that we're noticing that we may want that anybody can address by looking at that. So when we see our product, we can address spoilage, rework, scrap, and with the just-in-time system, since we're only making things just in the nick of time, or we're only making orders once we get we're only making product once we get an order, products don't sit on the warehouse shelves. So if there's and then with multi-skilled and cross-trained employees, they are all going to be efficient or should be efficient in the identifying of spoilage, defects, what have you. So we can significantly reduce, if not eliminate, the cost of rework, spoilage, scrap, and so forth. And again, with this, defects are aggressively eliminated. Anybody is empowered to stop the production process if they notice defects here. So that allows people who normally are not in the inspection process, but because they are cross-trained to look for certain defects, they can stop the machine as well, thereby aggressively eliminating defects. Setup time, manufacturing cycle times are reduced. Suppliers are selected on the basis of their ability to deliver quality materials in a timely manner. So the focus is, and yes, price does come in to some extent, but we want to have quality materials where we have an extremely, extremely low defect rate. And then we also want to receive those materials in a timely manner. We want to have those materials delivered to us so that we do not have to have big stockpiles of materials in inventory waiting for an order to be delivered to us by a customer. So what's some of the costs and benefits of just-in-time? Well, again, we've talked about lower inventory levels. And with lower inventory levels, we're talking about lower carrying costs. Because now we don't have as much carrying costs. We don't need as much warehouse space. We can turn around and use that extra warehouse space if we already have it to maybe manufacturing other products and using the alternative approach that we talked about a few chapters ago. Heightened emphasis on improving quality by eliminating the specific causes of rework, scrap, and waste. And then also we can lower manufacturing cycle times. So those are some of the costs and benefits of a just-in-time system. Now let's go back to the concept I introduced last session, and then a little bit in this session already. Enterprise resource planning, or ERP systems. Now, ERP systems are frequently used in conjunction with just-in-time systems. Now, why is that? Now, what is that? First of all, ERP system is a system of integrated set of software modules covering a company's accounting, distribution, manufacturing, purchasing, human resources, and other functions. There are going to be some basic modules where where everybody gets the same module, everybody gets the same set of functions. But there's also going to be additional modules that a company can have specially created or for them so that they can get additional insight that they're looking for. With an ERP system, we're going to get real-time information because it's collected in a single database and is simultaneously fed into all the software applications. So we can have greater visibility in the in the company's end-to-end business processes. So we can have greater visibility from beginning to end. Things are updated in real time, so we don't have to make decisions based on gathering orders one night, updating the system overnight, and then in the next morning coming in and finding out how much inventory do we have, how many units do we need to make, and so forth. Now, companies believe that ERP systems is an essential component to supporting just-in-time initiatives. And why? Because of the effect it has on lead time. And the effect it has on lead time is because that real-time information is collected. We can see everything in real time, so we know immediately when we need to place an order. And maybe the order is automatically placed electronically once they hit a pre-programmed reorder point. Or maybe it's because we have an order, and that's going to trigger we have an order from a customer, and that's automatically going to trigger certain specific orders to be placed with our suppliers. Now, the challenge when implementing an ERP system is to strike the proper balance between lower cost and reliability of standardized systems and the strategic benefits that accrue from customization. We can customize anything, but that comes at a cost. And ERP systems are not cheap. They are very expensive. So if we need to have some customization, we need to do a cost-benefit analysis to see is that cost going to generate enough of a benefit that the information is providing to justify that cost. So are we going to that cost that we're spending, can we justify that by the benefits received from the additional customization? When we talk about performance measures and control in a just-in-time system, now remember in other chapters we've talked about qualitative and quantitative information. When we, as finance managers, as accounting managers, as cost management personnel, we have to use financial and non-financial measures to evaluate control, to evaluate and control just-in-time production. So some financial performance measures would include inventory turnover ratio, which is expected to increase. Non-financial performance measures, inventory, quality, and time. And here are some illustrations of this. The number of days of inventory on hand, we expect that to decrease. Now, it's not financial, but it is quantitative. Units produced per hour, expected to increase. Number of units scrapped or rewiring or requiring rework divided by the total number of units started and completed is expected to increase. So our spoilage rate is going to decrease. Manufacturing cycle times, we expect that to decrease. Total setup time for machines divided by the total manufacturing time, we expect that to decrease as well. So we have some financial performance measures, such as inventory turnover ratio, because that's directly tied to the dollar amount of inventory that we are having on that we have on the books. But we also have non-financial, still quantitative, still important, but these are additional insights that we can get, and we should expect when implementing a just-in-time system. We should expect a number of things to happen with our key performance indicators and our non-financial performance measures. Now, by reducing materials handling, because remember we have those manufacturing cells, first of all, so we're reducing materials handling in that sense, but we're not carrying as much inventory across the board, so we're reducing materials handling, which is the transportation of materials from one location to another, warehousing, inspection. Those, by reducing those costs, we're going to reduce our overhead costs. And in some cases, just-in-time systems can also aid in the direct tracing of some costs that we are usually classifying as indirect. Now, with these changes, with the more direct tracing of some costs that would normally be classified as indirect under a standard costing system, under a traditional costing system, such as job costing, process costing, standard costing, and because of the reduction in costs, some companies now, because of all that, are using just-in-time, are adopting simplified product costing methods that dovetail with just-in-time production, and those accounting systems themselves are less costly to operate. And there's two of these methods we're going to look at: backflush costing and lean accounting. So let's take a look at backflush costing. In order to take a look at backflush costing, we need to look at traditional costing so we can do a compare and contrast analysis. Now, traditional costing traditional normal standard costing systems use what we call sequential tracking, in which we record the journal entries in the same order as the actual purchases and progress of production. So, once we purchase materials, we put them on the books. Once we transfer it to work in process, we record that transfer in the books. Once we incur conversion costs, we put that on the books. Once we complete work in process and now it's finished goods, we put that on the books. When we sell finished goods, we record that on the books. So we're sequentially, every time something happens in a traditional costing system, we're recording that on the books. From the purchase of materials and the incurring of conversion costs, production resulting in work in process, the completion of good finished units of product, and the sales of those finished goods. Now, those are the 4 stages in a sequential or traditional costing system. Now, in backflush costing, this is the opposite. As you see in the illustration screen here, we have stage A, C, and D with a little asterisk in case a trigger point for journal entries. In a backflush costing system, we can have a system where we only make journal entries at 2 trigger points, whichever 2 they are, or 3 trigger points, but we will not be recording each and every one of these. And so let's talk about a trigger point and discuss how it relates to backflush costing, because backflush costing is going, and let's talk about the trigger point. A trigger point is a stage in the cycle from the purchase of direct materials to the sale of finished goods at which journal entries are made in the accounting system. So a trigger point is whatever point we're at that requires us to make a journal entry in the books. That's all a trigger point is. Trigger point is simply telling us when are we going to create a journal entry. Now, backflush costing omits recording of some journal entries somewhere in between of purchasing direct materials to the sale of finished goods. So we're not going to look at doing journal entries for each one of these 4 steps. A trigger, in some systems, we may only record the sale of finished goods and the purchase of direct materials and incurring conversion costs. In other systems, we may record journal entries as step A, C, and D, and so forth. So, because now some stages are omitted, the journal entries for a subsequent stage or the next stage here, and let's assume that we have a company with only making journal entries at 3 trigger points: stage A, stage C, and stage D. We'll say that we come across some inventory and we hit stage C, where we have a trigger point. So we need to do a journal entry here at stage C: completion of good finished units of product. Now, backflush costing is going to say we're going to flush these costs out at this point and consider them in the completion of good finished goods units. So we're going to work backwards to flush out the costs in the cycle for which journal entries were not made. Now, when inventories are minimal, such as in just-in-time production system, backflush costing simplifies costing systems really without losing a lot of information. And that information that we're missing is going to be very minimal in nature. Now, backflush costing, and as we'll see with lean accounting, does not necessarily comply with GAAP. However, because inventory levels may be immaterial, and remember the materiality concept for financial accounting that we learned about, if these levels are immaterial in nature, it may negate the necessary for compliance. But backflush costing does not leave a good audit trail to pinpoint for the accounting system to pinpoint the use of resource at each step of the production process. So we don't have a good audit trail. However, the absence of sizable amounts of material inventory, work in process inventory, and finished goods inventory, because we don't have a lot of inventory to manage because we're keeping it very, very minimal, we can keep track of operations by personal observations, computer monitoring, and non-financial measures. So we can pay more attention to operations instead of dealing with sizable amounts of inventory. Now, another simplified costing system that we can use with just-in-time systems or lean production is lean accounting. Now, lean accounting focuses on the entire value chain of the business, from suppliers to manufacturers to customers, in order to reduce inventories, lead time, and waste. So we're looking at lean accounting. Backflush sequential costing journalizes everything as they occur. Backflush costing only deals with things and flushing out those once we hit a trigger point and flushing out those costs. So we're waiting until something happens and then flushing out all the costs that happened before. With lean accounting, we're dealing with the whole entire value chain, from research and development, design, production, distribution, marketing, and customer service, and also from our suppliers as well. So we're not only doing the value chain, but in reality, we're looking at the supply chain as well. So with this, since there's been improvements in the value chain, and a lot of companies have seen improvements in the value chain at the value chain level, so some companies will adopt organizational structures and costing systems that focus on value streams. All value-added activities needed to design, manufacture, and deliver a given product or product line to customers. So we're focused on value creation across the value chain. Now, lean accounting is a costing method that focuses on value streams as distinguished from individual products or departments, so thereby eliminating waste in the accounting system. So we're changing the cost the costing method, focusing on the individual cost object, what individual products that we produce, whether it's that bottle of ketchup or that stapler or that calculator we make. but we're focusing more on the entire value stream. And so since we're doing that in the lean accounting, we're reducing the number of journal entries, what's going to happen is we're eliminating waste in the accounting process. So there's less accounting going on as far as journal entries and the activities related to that. We're eliminating a lot of that waste. Now, value streams, remember, are the value-added activities needed to design, manufacture, and deliver a given product or product line to customers. So that's what value streams are. All the value-added activities needed to design, manufacture, and deliver a given product or product line to customers. Now, in a lean accounting system, and the focus being on value streams, we can trace more costs as direct costs because we're dedicating resources to individual value streams. So really, in our individual parts of the value stream and our cost object. And that's more of where we're tracing more costs as direct costs because we're tracing those costs to value streams instead of an individual product. Now, lean accounting obviously is much simpler than traditional product costing because calculation product cost by value streams, it requires less overhead allocation. But there are some criticisms. And so we're going to talk about 3 criticisms, and we're going to talk about the 3 responses that are given to each criticism. First of all, critics of lean accounting charge that it does not compute the cost of individual products. So I don't have a product cost per unit. So therefore, the information is less useful for decision-making purposes. 2, critics of lean accounting charge it excludes certain support costs and the cost of unused capacity. And remember, we talked about in inventory management back in Chapter 9, the cost of unused capacity, the production volume variance, and so forth. Critics of lean accounting say that we don't measure the cost of unused capacity to see what the capacity is really costing us. And finally, like backflush costing, it does not correctly account for inventories under GAAP. So what do lean accounting proponents say to that? Well, individual product costs, the lack of individual product costs is not a problem because decisions are made at the product line level rather than the individual unit of output level. And the pricing decisions are going to be based on the value created and not product cost. So everything that we have looked at, whether target pricing, cost plus pricing, we don't create pricing decisions based on those. Lean accounting says we're going to base it on the value created, not how much a product costs. Exclusion of certain costs. Proponents argue that the method overcomes this problem by adding a larger markup on the value stream cost because customers will be unwilling to pay for non-value added costs. And then finally, with non-compliance with GAAP, here proponents, just like in backflush costing, the amount of inventory and work in process and finished goods are immaterial in nature from an accounting perspective. So therefore, it doesn't really matter that we do not use the traditional direct manufacturing, direct materials, direct labor, and manufacturing overhead allocated to individual product costs here. And the reduction of certain journal entries, it doesn't matter because that doesn't comply with GAAP because it's immaterial from an accounting perspective. So we talked about just-in-time in this session. We talked about 2 accounting systems that work with just-in-time, backflush costing and lean accounting. And remember that backflush costing kind of gets us a closer sense to sequential costing, but it's not quite as accurate because we're waiting to a trigger point and then we're recording the value of those activities that occurred before that. In a lean accounting system, we're focused more on value streams and the cost that we assign to a product or a service is based on the value it creates, not the cost of actually necessarily producing it. So my name is Leroy. Thank you for joining me. Have a good day.